I always tell borrowers, ask your servicers, what are my options? What can I do? What is the lender willing to do with me? We are always going to ask you about your financial situation to make sure you can actually afford it. No lender should put you in an agreement without verifying that you can actually pay for it, that you can afford it. You're not supposed to want to default again.
Welcome to the Rental Property Owner and Real Estate Investor Podcast, brought to you by the Rental Property Owners Association, where real estate investors have found success since 1968. I'm your host, Brian Hamrick from Hamrick Investment Group. This episode is sponsored by Green Property Management, managing everything from single-family homes to apartment complexes in the West Michigan area. Find out more at greenpropertymgt.com. And RCB and Associates, helping real estate investors and small business owners navigate the complex world of health insurance and Medicare benefits at rcbassociatesllc.com. Hello and welcome to episode 440. After the housing crash in 2008, millions of struggling homeowners asked for loan modifications with their lenders. Many of these homeowners were relieved to find out that their lender was willing to forgive their second mortgage as part of the modification process. That was all well and good, and it saved borrowers hundreds, if not thousands, in monthly payments. But now those second mortgage loans are coming back to haunt them. And the investment groups that bought up those loans for pennies on the dollar are foreclosing on them in order to sell the property at a profit. There are few people who understand this strategy better than my guest today. Shante Duffy is a trusted expert in the note space, and she's going to help us understand this strategy both from the investor's point of view while offering suggestions to homeowners who might find themselves in this sort of zombie second mortgage foreclosure situation. Shante, thanks for joining us today.
Thank you for having me.
Why don't you just tell our listeners a little bit about your background and the things that you've accomplished?
I have been in the note space for a little over 11 years now, but my knowledge and specialty always came from servicing. I have worked in servicing for about 11 years now, and then kind of decided to join helping out with the fund that kind of has asset management and kind of overseeing stuff like that. So I know the servicing side of this note industry pretty well. It's part of the industry that I love, but always gaining more knowledge and meeting new people and networking and expanding. So yeah, my knowledge is basically on performing assets, non-performing assets, senior liens, junior liens, foreclosures, bankruptcies, things like that. So that's kind of my background in this space.
I called you yesterday or the day before because I saw this article. It was on NPR.com. And it was from the perspective of some homeowners who had gone through the foreclosure crisis back in 2008 to 2011, whatever that period was, a Great Recession. And a lot of people, including some people that I know, had second mortgages on their homes. And this article was about how they had been told back at that time when they modified their loans that these second mortgages had been waived. Like, you don't have to worry about them. They're gone. You don't have to pay them anymore. But lo and behold, they've come back, 10, 15 years later, and investors have bought up those second mortgages and are now foreclosing on their homes, these homeowners' homes, because they haven't been paying on them. So and first of all, you know this, what we're talking about, right? Is this something that you're familiar with?
It is something I'm very familiar with. So reading that article, it wasn't a surprise to me, but I can see why a lot of people are super shocked, at least the investor side. I can see why borrowers are really surprised as well. The first thing that sticks out to me, though, is if your senior lien and junior lien are not owned by the same lender, your senior lien can't sit here and tell you anything about forgiving your junior lien. They're not the note holder. They're not the lender on that loan.
People that are listening haven't read that article. So there is a link to the article in the show notes. Let me give a little bit more context before we because we're going to look at it both from the investor side and the homeowner side. But leading up to the Great Recession, pre-2007, there were a lot of 80-20 loans. Let's start with that. Like, why does this problem begin in the first place? What were 80-20 loans? How did they lead to the second mortgage zombie problem that some homeowners are facing right now?
The 80-20 loans, I actually have family and friends that kind of fell into that as well. So I am pretty familiar from their side as well. It's where borrowers are going after a home and they'd end up with two mortgages. The senior lien would be 80% of the mortgage and the junior lien would take 20% of the remaining balance. That's kind of really where that split came from. So there's two liens automatically when people are closing on their homes. That's where that junior lien comes into play.
This was common before the Great Recession, right? Before the housing bubble burst, which is partly why the housing bubble burst.
Yep. I've not seen any of these since then or post this time that I've seen. I'm not saying they don't exist, but I just haven't seen them. So that was the most common why so many borrowers had two liens on their homes.
So they got the 80-20, the 20% help cover their down payment. It was a second lien, a second mortgage. And then when everything burst and people were losing their homes in foreclosure, part of the modification process was that lenders were telling the borrowers that they no longer had to pay on those second lien mortgages anymore. Talk about that. Like, what do you know about what was being told to borrowers about that?
I have such a hard time wrapping my head around it because I am not understanding how any lender is saying you don't have to pay back on a second lien without any documentation, any written agreements, any releases, satisfaction, deed and lose, anything. I don't know how they just wiped that out and how any borrower is just like, okay, I can see why the average Joe homeowner, though, would be like, oh, okay, no problem, because you're doing a modification. You're resetting the terms of your original loan, especially that senior lien. So I think a lot of borrowers were informed incorrectly, or they weren't receiving the knowledge in a way that it was understood. I think to me, I'm not sure because never was a lender that told any borrower that, and I never was a borrower that was told that. I'm not sure if lenders were 100% incorrect or if the borrowers weren't understanding properly. There's definitely some sort of disconnect there. For any borrower to think that they don't have to pay on a loan and do nothing with it is kind of the crazy part. And I've seen this article actually going around on LinkedIn for the past 2 days as well. And it's funny, a lot of the comments that I'm seeing, it's like, why would you think you didn't have to pay it? But if someone had told them that, my advice to everybody is get that in writing, to have that put somewhere, because it's at that point, it's a hearsay situation. And good luck trying to track down the person that told you that, well over a decade later.
So I have a slightly different perspective because I did have a family member who received a letter that's from, and I believe it was from Countrywide, or it was after Countrywide went out of business. And they did receive a letter saying you no longer have to pay on your second mortgage. And the letter did indicate that that mortgage had been relieved or wiped. So I don't doubt the homeowners when they say that they receive something from their lender saying you don't have to pay anymore. But what most homeowners are not aware of, what you are clearly aware of because you're in this world, is that just because someone says you don't have to pay on that loan anymore doesn't mean that it doesn't exist. So just for homeowners who are listening to this right now and saying, well, I got that letter 15 years ago, I don't know where it is and I don't have any record. What should they have received at that point to say, hey, you legally don't have to pay on this loan anymore?
There needs to be some sort of release, because at the end of the day, there's still a loan and a lien tied to this property that borrower, John Doe, is responsible for. So when you just get a letter that says you don't have to pay it anymore, I'd love to read the language in it because I've never seen a letter like that. I'm not saying it doesn't exist. I'm just not familiar with it. But I do think that borrowers need to start questioning a little bit more, and they need more proof that says that they are not obligated to pay. They're being released from paying this, whatever the case may be. If it's just you're not paying it, there's nothing that voids that loan right now. Like that letter doesn't void that. It's still an active loan. It's still an active lien. You might not be paying on it, but it's still out there and it still exists. And I think that these letters that might have been sent to some of these homeowners are maybe that lender might have charged off the loan on their end. But I really think what ended up happening is the lenders sold the loan and kind of went to just another lender who purchased it at a discounted rate. And they probably just shelved it. I've worked with a lot of lenders that buy junior liens, and if they try to work stuff out with the borrower, if they're not getting very good traction, or they kind of want to wait for many different reasons, they shelve it, which means that they kind of just put it on the shelf and wait. They would give it some time, and then they come back to reevaluate and rework out these loans. So I would tell borrowers, at the very least, you need more than just a written letter. You want to see that it's been satisfied or released. And if there's nothing recorded releasing that loan, it's still there and you're still responsible for it.
Yeah, well, I'll tell you what I think happened is that the lenders charged them off or wrote off the second loans because they knew that they would never collect on them. The government was putting pressure on them. And what they told, because I do 100% believe the homeowners when they say, oh, our bank told us we didn't have to pay that anymore. We were told, I don't remember how we were told, but I know that they were told because I've seen those letters, but they weren't told the full story because while the lender might have been saying, hey, you don't have to pay us anymore, that those loans kind of became garbage loans that investors could buy for pennies on the dollar, right? I mean, maybe, I think in the NPR article, someone bought 9,000 seconds for $6,000. Well, at the time, maybe that's what they were worth. But now you wait 15 years later and prices have risen, the values are now there. So those investors who bought those for pennies on the dollar are now coming back. And this is the return of the zombie second mortgage, are coming back to lay claim. So yeah, I think we're kind of caught up to where we are today. So now that in the article, we're reading about homeowners who were unaware of what's going on, who are getting phone calls now all of a sudden from the people who bought these notes, the investors, saying, hey, you still owe us this money and there's all this interest owed. And of course, the homeowners had no idea what they were even talking about. So talk about what from the investor's point of view, because we're going back and forth here between the investor's point of view and the homeowner's point of view. But from the investor's point of view, what's going on with them? What's happening for them? Right?
I think that these investors had shelved them for so long, and we're looking at the real estate market. House values are pretty high. People are okay right now. And I think they're taking them off the shelves and trying to work them. I think they're boarding them with their servicers, having their servicers start handling borrower outreach and loss mitigation, because these are essentially non-performing loans in second position. Maybe they paid off their first as well, which is why it's now, okay, the first lien's gone and now the second lien moves up to first. I think investors go after many different reasons. At the end of the day, they have still have a loan they have to do something with at some point. And I think they're just kind of brushing off the dust right now and starting to take action.
Let's dig into that strategy a little bit more, because I know we've talked about seconds on the show, but just kind of give us the 101 on how do seconds work from an investment standpoint? Because most people would think, well, Bank of America has my first mortgage. Second, there's really nothing they can do to touch me because Bank of America stands in their way. But that's not the case, is it?
You can still foreclose from second position. And that's the one thing that homeowners don't know. So most people take out the 80-20. There's plenty of times that borrowers take out a loan and then they take out another loan 10 years later to renovate the kitchen, build a pool, send their kids to college, whatever the case may be. And a lot of those are lines of credits. And they feel that if they don't pay it, that nothing happens. They don't get penalized. They can't be foreclosed on because it's not their senior lien. That is 100% false. You can be foreclosed on from junior position. Lenders have that right, and they will exhaust that right if you choose not to pay. So a lot of that article expressed how lenders started notifying their borrowers, notifying the homeowners, hey, you have this loan. And a lot of homeowners just ignored it because they haven't heard anything about it, seen anything about it for 10 years, and they ignored it. That's when you end up with sheriffs knocking on your door, posting the sales and going through the entire foreclosure process and your house going up for auction. Lenders still have that right. And I think that's the biggest misconception that homeowners don't know about. I know when I got into the space, I learned that. And I remember being like, well, why wouldn't you? Because again, it's still an agreement. The agreement outlines exactly what the options the lender can take if the borrower defaults. It's just that people think they don't pay it, and after 10 years, we don't have to worry about it. Or maybe it's a line of credit and the draw period is over, and they're just like, well, I didn't use the whole loan balance. It's very different, but lenders have the right to foreclose.
So not only was the homeowner getting these calls from people they don't know about a loan that they thought had gone away, and I legitimately believe that they were told in some way or another that those loans, they no longer had to worry about them. But now all of a sudden, 15 years later, they're getting these calls from some stranger saying you owe us money. So a lot of them in the article called their lender and said, I'm getting these calls. What should I do? And the lenders were saying, ignore them because it's probably some sort of scam. So even the lenders in the first lien position aren't really savvy to what's going on with these second liens, are they?
I don't think that they're not savvy. I think it's when a homeowner is calling, they're calling the first lien holder. So the senior lien's maybe not aware that the junior lien's coming back for collections. I don't think that the primary loan, the first lien position is wrong. I just don't think they know. And I feel like they should not have given out that information to just ignore it. Because ignore it. It's not us. I can see why that had been said, but the right response should have been call and find out. It's not in regards to this loan. We have not sold anything. We have not transferred anything. Everything here is fine. But these letters are detailed. On the borrower side, part of me is also like, it tells you who to call. So I kind of have mixed emotions because it's somewhat shocking as to why a homeowner would call a primary mortgage company, their senior lien mortgage, in regards to a document that came from somebody else in a totally unrelated loan. And I promise you that these documents and these calls and these letters that they're getting are including the original loan that they're talking about, that junior lien. I just don't think that the borrowers are aware or knowledgeable enough to recognize or even to remember. You have to remember, this is, over a decade ago. To remember, oh yeah, I did take out a second lien in 2006. Why would you be worried about it almost 20 years later? You're not really thinking, especially if you haven't paid on it.
I'd like to take a moment to tell you about Green Property Management. Not only do they manage everything from single-family homes to apartment complexes in the West Michigan area, they also manage my entire portfolio. So I can tell you from personal experience that their unique flat fee management style is worth a closer look. If you feel that your property isn't operating to its fullest potential, then Green Property Management can help you take a holistic approach that will save you money, eliminate your headaches, and increase your net income. And if you're a property manager interested in applying Green Property Management's model, give them a call at 1-866-95-GREEN or visit them on the web at greenpropertymgt.com. If you're thinking of leaving your W-2 job and becoming a full-time real estate investor, one of the greatest costs you must consider is healthcare for you and your family. When I made this transition myself, I found the whole healthcare insurance process to be confusing and frustrating. That's why I'm glad I met Chad Creasy at RCB and Associates. Chad is a professional health insurance agent who helps real estate investors and small business owners understand and choose their best healthcare options. And best of all, his services are covered by the insurance company and won't cost you a dime. If you live in Michigan and are expecting a change in your healthcare insurance coverage for any reason, or losing employer coverage or transitioning into Medicare, then you owe it to yourself to contact Chad Creasy at rcbassociatesllc.com. As a homeowner, if I was getting a letter like that, I'd immediately think it's some sort of scam. It's just someone trying to get money from me because this loan went away 10 years ago.
I agree with that rule of thumb until you start getting an attorney letter. You don't get foreclosed on without a demand letter.
Once the attorney letter comes, that's when you know it's serious, huh?
From my history and what I've seen and my experiences is that, servicers can send whatever letters they want. Statements, late notices, hey, you need to contact us, all of it. That's what servicers do. That is their job, part of their job. I can understand borrowers ignoring that, but I've also seen borrowers ignore that for a year and a half, and then they get an attorney demand letter, and all of a sudden it's, oh no. And that's when they could turn around and say, okay, what is this about? I understand people forgetting things. I truly do, but I don't think that's the case for everybody.
And we know from the note fund that we have together that a lot of borrowers use the head in the sand tactic when it comes to these kinds of things. So there is a certain amount of denial that's going on. But I want to just argue on their behalf, because if I was receiving that, I would be saying this is BS. I'm not going to pay it. Go away. But let's switch to the homeowners and the borrower's perspective now. Let's say they did have a second. They're listening to this and they're like, oh my gosh, I had a second that was waived 10 years ago. Maybe that's out there too. It probably is, isn't it? And how would they find out? How would both the homeowners who are getting these letters and the ones who are now worried that they might get these letters, how would they find out if these seconds are still out there?
The top two things I would tell everybody to do is to run a title report. That'll show you any active loans on your property for, up to 30 years kind of thing. The other route, it takes a little bit longer, but you can do it usually by yourself, is go to the county recorder's office. See if there's a second lien that is recorded. Most of them are. And if there's nothing that'll tell you also who currently owns it. Just because you took it out originally with Bank of America does not mean it's still with Bank of America. So that'll give you the chain of ownership that is transferred from person A to person B to person C, and so on and so forth, and try to track down that information. So if you if you haven't received anything and you're like, oh, wait, I have a second lien, you can go order a title report, or you can check with your county recorder's office and try to get a trail of the deeds on that second lien.
To order a title report, we just find a title company and say, hey, can you pull a report on my house?
Yeah, you can also, there's tons of different title companies to use. The ones that I'm familiar with, I'm a good friend of and things like that was a Pro Title. You can ask them to help pull a title report, and they'll give you the entire history on each loan that you have at that property, where it stands, if anything's been recorded, if it's been satisfied. It tells you exactly what's been recorded as well. So it kind of gives you a snapshot of everything in one spot.
Is that a deep enough dive? Because I think you were telling me when we talked yesterday that like if it's filed at the county level, sometimes the title company might not even be aware of that.
Title company should be, because they also are pulling that. That's what's coming on that report. But I haven't had any. The only time it's an issue is if the current owner or a few owners back, which you and I've seen in the fund, don't record their chain of assignments, their ownership. So when a lender sells a loan, an assignment transfers with it and it assigns it over to the new lender. If they don't record that, though, the county's not going to pick that up. And that won't be picked up on a title report.
All this time has gone by. There haven't been any monthly statements. I know one of the parties, one of the homeowners in the article had kind of staved off the foreclosure process because they hadn't been getting statements saying, hey, this is how much you owe and this is how much interest is accruing. And by the way, it's not just the amount that they borrowed, it's all the interest that has accrued over this period of time. So these are shocking bills that they're getting. But if they're not getting those monthly statements, what does that mean? I mean, isn't that a requirement that the monthly statements be provided? How can you just come back 10, 15 years later and say, oh, you owe us this much money, pay it?
Specifically, home equity lines of credits, they follow a little bit of different rules. I naturally want to sit here and be like, yeah, every loan should get a statement no matter what. Whether they're paying or not paying, they should get a statement. I believe that to me, that is correct. But by law, you're not obligated to, especially on a home equity line of credit. There's different rules and regulations per the CFPB that state when you have to and when you don't. So a lot of people get away with it, especially if it's a line of credit, if you're not obligated to send monthly statements. So a lot of lenders kind of have that on their, as their defense side. We're not obligated to. They're not violating anything. It's in good conscience, I believe. I think it's morally and ethically proper to send everyone statements, whether, you're collecting anything or you're not. But again, these are also lenders that have shelved these loans. They haven't touched them in years. They've owned them. They're not doing anything until now. So a lot of lenders won't go put a loan with servicers if they're not going to do anything on it. So that's also why borrowers aren't getting a lot of that communication, and they will spark it up with the servicer again when they're ready to start. And they kind of give these borrowers, from what I've seen, a pretty short window of time to start working with them. What lenders, I think, forget is this loan hasn't been touched in years. We haven't sent them. If you held this loan for 6 years, you've done nothing on it for 6 years. So I sometimes feel like giving the borrower 30 days to kind of get their bearings also isn't enough. Borrowers will question. Borrowers have the right to ask and validate the debt. Like, there's definitely ways that borrowers can get the information, confirmation. I always tell borrowers, there's this thing called the shock and awe package. Request it. Prove that the loan exists. Prove that it's yours. Prove that the lender is the current lender, and that's who it should be. That's where the assignments and the loan just kind of come into play. And then at that point, it's in the borrower's best interest to try to work something out so you're not foreclosed on. Some lenders want the property. Some lenders just want you to keep paying or to continue to pay, start paying again. Every lender is different. So how I would handle it as a lender would be different than how you might handle certain things versus anybody else. But I do tell borrowers, you are responsible for it. So a lot of lenders are willing and flexible to do some loss mitigation efforts and work out payment arrangements, whether they're modifications, things like that, forbearance plans, things to avoid foreclosure. I kind of tell borrowers, if you can work that out, that's probably in your best interest to not have a foreclosure underneath you.
First and foremost, if the borrower took out that loan 15 years ago, they owe on that loan. Doesn't matter if their previous lender said, oh, you don't owe us anymore. that money is still outstanding and it's been waiting to come back. And now it's starting to come back because there's so much value in these houses. So you can't really argue from that standpoint unless they actually got something in writing or something that will hold up to say, yes, this loan was waived.
It has to be something that contradicts what the lender's presenting.
So you would want to find that. But the next step for a borrower when they find themselves in this situation and they're being contacted is, you said, ask for a shock and awe package, and hold our hand and take us through what a borrower should actually, how they should handle that. Do they need an attorney to do that on their behalf?
No, they can ask for it themselves. You can ask the servicer. If that's who you're in communication with, you can ask your lender, and they will basically bundle up and provide you with copies of the note and mortgage that you signed whenever you actually took out the second lien. You want to make sure that the debt is validated. I think borrowers should do that, especially if it's a loan that they thought was written off or, released or satisfied. I mean, I'm sure some of these borrowers may be paid, and just, any amount of proof and evidence that this loan exists and that it's owed to you, I do think that every borrower has that right to ask for. And so I don't think they realize that they can. So there's been plenty of times in, my history where I'm like, well, borrowers are like, I don't owe on this loan. This loan was given. And I'm like, no, it's not. And I'm like, this is what I'm going to do. I'm going to send you a shock and awe package. It's going to show you. And it's also going to compile of the entire collateral file. So the note, mortgage, or deed of trust, and the chain of assignments and allonges, as well as the payoff for that loan, so that you can see exactly how much is owed, exactly how much worth of late fees, accrued interest, any other penalties, any advances, anything like that have been added to their loan, to see the entire balance. And yes, these balances end up being astronomically high with, loans that haven't been paid on since 2010. A lot of time has passed by. So I always have provided that to borrowers who've said, no, I'm not supposed to do this. And it's like, well, this says you are. And so we make sure they receive that package. We review any questions that they have with them. That's what I've always done. And then it's okay, so what's the game plan? Because at the end of the day, now you have all the information. You're like, oh, okay, this makes sense. And okay, what are we going to do about it?
The borrower has rights and they can ask for all of these things. Most people, and I put myself in this category too, most people don't even know what they're looking at when they receive these things, allonge, deed, all those things. So how do they, first of all, make sense of what they've received when they get this shock and awe package? And then second of all, negotiate it, because it is possible to negotiate these things, right?
Yes, it is. I always tell borrowers to work with your servicers. They're the ones that kind of are advocating for you on behalf of the lender as well. So when you get all this information, try to work something out that avoids foreclosure, whether it's a forbearance agreement, it's a modification, something, so that it's not a negative impact to you as a homeowner. And at the end of the day, it's a win-win for the homeowner and the lender. The lender's going to get this loan paid off, and some lenders are willing to do certain things. You can offer, I've had borrowers who are like, I don't have, let's say the entire payoff's $100,000. They don't have $100,000 to pay off, but they might be able to pay off 65. We'll ask lenders, would you take a discounted settlement, discounted payoff? Would you take that? Or would you take a larger lump sum for smaller monthly payments over the course of X amount of years? There's different ways to get borrowers to pay within their means, so that we don't end up in another situation that's defaulted. You don't ever want to go backwards. You want to go forward and make it successful. So I always tell borrowers, ask your servicers, what are my options? What can I do? What is the lender willing to do with me? We are always going to ask you about your financial situation to make sure you can actually afford it. No lender should put you in an agreement without verifying that you can actually pay for it, that you can afford it. You're not supposed to want to default again. So they might ask you for a financial application to be completed, or a hardship application. If you say, I can't pay for this, you're going to ask you for proof. We want to see what your income is. We want to see where you spend your money. We're going to ask for bank statements, tax returns, pay stubs, as well as a list of all your actual expenses on a month-to-month basis kind of thing. We're going to review all that to see if there is money to work with. There's plenty of situations where borrowers don't have the income to make up for this, where it leads the lenders to no other route of foreclosure. There's plenty of times where borrowers are, I'm just going to ignore it. And they ignore the entire thing. And then there's a foreclosure sale that they realize. And if they catch it, I've seen borrowers who've, to avoid foreclosure, have filed bankruptcy. to get restructuring of their debt. They know that they have to pay for it. They don't want to lose their homes. They don't, there's many different reasons. That's also another option that I've seen borrowers use. Lender, depending on what chapter bankruptcy they file and how that all works out, lenders can still get paid. So bankruptcies aren't always a negative. I know a lot of lenders are like, no, bankruptcy, and they run away. It's not always a negative. Especially if they're not trying to, wipe out that debt.
And not a negative for the lender or the borrower, do you mean?
For the lender. I think a lot of lenders that I've, spoken with and networked with over the years, they see bankruptcy and they want to go running. I don't think that it's actually, and I think it's just not having enough knowledge. But bankruptcies, a lot of times payments are restructured to where, hey, lender, you weren't getting paid at all, but now you have a claim in this case and they can restructure payments for the next 60 months to make sure that you're getting paid for it.
You described a lot of things there. What you described were reasonable conversations between a lender and the borrower, where you try to, as a lender, you try to determine, well, can the borrower start paying on this monthly? Could we negotiate it down? You talk about a lot of reasonable things, but from this article, it sounds like some of these lenders are not reasonable, and their goal, their aim is to get the house and foreclose. So as a homeowner, is bankruptcy the only option, or are there some other strategies and techniques that they can employ to prevent that from happening?
Bankruptcy will halt a foreclosure until that bankruptcy is completed. And it doesn't mean that it's always it's not guaranteed either. Borrowers, if they don't do their part within that bankruptcy, it does require the homeowner to do work. If they don't follow the requirements of the courts and the trustee, that bankruptcy will be dismissed and you're back in the same situation. Lenders will keep an eye out for that. They get notified. They have to. It's their, they have an interest in that loan. Again, communication. All lenders want to hear is that you want to pay it back. You want to take care of it for the most part. There are lenders who are going to go after this and go after it for the property for different reasons, their own prerogatives kind of thing. But communication, like when you get those letters, answer them. Call and see. Not every piece of mail that you're getting is spam. Not every phone call. I trust me, I understand it. My phone goes off all the time. But answer it and find out and ask for information. They're calling you for a reason. They're sending you stuff for a reason. Don't ignore it. Ignoring it kind of just pushes the problem. It doesn't get away from the problem. It doesn't fix the problem. Because then what happens is you ignore it. And like that article, you have the entire sheriff department at your front door evicting you. So to me, it's respond, acknowledge, reach out, and be proactive. As a borrower, it's your loan. You took it out at the end of the day. You are responsible for it. So be proactive. Lenders will work with you for the most part. I've yet to really see a lender completely be like, absolutely not, when borrowers are actually trying.
So deal with it head on. Don't stick your head in the sand and pretend it doesn't exist.
Borrowers have every right to confirm this with their attorneys and have other people, speak on behalf of them if they fill out authorizations and things like that to help them. They just need to be proactive. And that's really why a lot of this is surprising to the homeowners, but to lenders, we're kind of like, no, this is the recourse for a loan that's not paying. It doesn't leave lenders with much option either if you're not communicating.
I want to go back to the investor's point of view, though, because there might be some confusion on the listener's part and even my part as to how the strategy works. Because if you foreclose on a second, and this just goes back to investing in seconds 101, but if you foreclose on a second, how do you get the money? How do you get profit if the first is still in place and that has to be paid off first?
What I've seen lenders do, they foreclose in second position and they will actually go list the home for sale. Like let's say it reverts to an REO, so nobody bid on it at auction. You now have the deed, you process the eviction. The borrower still can be evicted. That doesn't change. And let's say you listed the property. So let's say this borrower owed you $100,000. Let's say the first is got a $200,000 balance on there, but the property today is worth $500,000. If you sold that property today, that first lien gets paid off. And you get, not only did you go through the entire foreclosure process, you get the proceeds from that sale as the REO owner as well. So the first lien will get paid off. And at that point, the property's gone, borrower's gone, there's no loans at all on it. And it's off to the next homeowner that purchased it.
So not only does the second lien holder get the amount that's owed to them, they also get any proceeds from the overage after the first lien is paid off.
They will get everything outside of the first lien paying off.
That brings up another strategy for homeowners, which is sell your house. Sell your house, pay off the first, pay off the second, keep the profit. So let's make sure that that's on the table too.
I know that's a hard outcome for a lot of borrowers, especially in today's like real estate climate. You know, people are also attached to their homes. You know, as a homeowner, that might be the house that you raise your children in. You know, that there's it's where people live. So at the same time, there is an attachment there. Borrowers do have options. It's not always to just go to foreclosure. It's not always to just sell the home. But I can completely understand why a lender would foreclose on a loan that has some equity in it.
So as we wrap it up, Shante, I feel like we've kind of looked at this from both sides, the investor side and the homeowner side. But one question that is really gnawing at me is, isn't there some sort of statute of limitations? I mean, if these loans were 15 years ago and they haven't resurfaced until now, are they still valid?
That's kind of where I'm not 1,010% sure. From my own personal experience, I had purchased a note where I couldn't foreclose because of the statute of limitations. So it's genuinely a dud. And my borrower is deceased anyway. Like I bought the loan, went to go foreclose, and they actually changed their laws like the year I bought it. So as I'm working with my attorney, we're getting through the process of doing everything. It's, oh, Shante, by the way, there's a new law. You're past statute of limitations now. And I was like, okay, so like I really couldn't do anything with it. And it's just done. The borrower's deceased. So there's no signing the property over. There's nothing I can really do at that point. But I definitely would tell lenders to check with your attorneys. They would be the most well-versed to answer that question.
State by state kind of thing, or would it be a federal thing?
It'd be state by state. So the state that the property is located in is what you should be hiring an attorney to handle the foreclosures for, in states that they can work in. And I would ask that question as well.
What about if you did have the second, it was forgiven, and then in the meantime, you've sold the house and you no longer own it? Is that second still valid for the new owners, or is that completely gone away?
There shouldn't be an issue if you sold the home, because at closing and, you know, when you're selling a home, there's title reports that are being pulled, making sure every lien is satisfied. So you might have sold the loan and actually paid it off and didn't realize it.
Oh, really?
Yeah. When you end up selling your house and getting the proceeds for that, you still hadn't, you at least had a senior lien, that would have been paid off too.
I'm sure this has come up millions of times since that period. I mean,
you'd have to find out who the second owner is. Like that, they're entitled to that. If there's an open lien on that property, everyone has to be taken care of before you can sell a property completely in its entirety.
Let's say I bought a house in the past 5 years. I don't need to worry that there might have been a second lien on it at some point.
No, that would have been taken care of. You need clean title. You should have had clean title when buying the house. So that would have been taken care of with the prior owner.
I feel like the second lien situation would have come up many, many times with title companies, where title companies would have found second liens that the homeowner thought was waived. So I'd be curious from their perspective, like how
I think that they've actually been handled. I don't think anyone, if you sold the loan, I don't really think you have anything to worry about, especially if it was sold at a sale and paid off.
If you sold the home.
The home. Yeah, that's I'm sorry. If you sold the home, it would have covered any outstanding. It would have had to been taken care of at closing. So I would imagine that a lot of these junior liens that everyone's now going to be worried about, zombie apocalypse kind of style, that a lot of them, if you're no longer in that home and you sold it, or maybe you got foreclosed on from your senior position, that'll wipe everything out as well.
Wrap it up for us with your thoughts to homeowners. Like, you know, what's the message?
My advice to all homeowners: communicate, be open, be honest, get everything in order. At the end of the day, this is your home. You are living there, whether you have family, friends, whoever the case may be, that's where you live. So take care of it. Not all lenders are bad. I think a lot of borrowers kind of give the rap of, oh, my lender's just this big bank, or it's a lender that doesn't care. That's not the case. They are willing to work with you. So I don't want that to ever be misconstrued. I do think that lenders kind of get a bad rap from their homeowners on that end. So communication, that's always going to be my rule of thumb. Communicate. If you're not sure, find out. If you're really not trustworthy of it, you have every right to go obtain an attorney to help you review it. You know, if you're not sure, there are resources and things, just call and find out and get as much information before you just chuck another piece of mail for something that doesn't look right, especially if it's mortgage related.
How would people find out more about you, get a hold of you, and who do you want to get a hold of you?
You guys can reach out to me. You can find me on LinkedIn. You guys can also email me at shanteduffy@outlook.com. I have no problem answering questions. I'm definitely a lot more investor/lender facing, but if borrowers have general questions and just want to understand how to reach out to a lender and steps to do that, I have no problem kind of giving some ideas and pointers to kind of guide you guys through. So don't hesitate to reach out if you have any questions.
And what's your favorite hack or app?
Honestly, my favorite app right now that I'm generally just glued to all day is this smart news app that I was able to modify to the things that I like and only I like. So it'll range from obviously this real estate industry and, finance world to the craziest of things of, reality, true crime that's going on in the world. But I use that a lot. And next to that, I use my Spotify app to listen to podcasts. So that's where a majority of my time is spent.
What's the first app called?
I think it's called a smart news app, but I'm able to make it to what I want to see. So if I don't want to deal with like entertainers and care about what, the entertainment world is doing, I don't pay attention to that. So I'm able to put, finance and, politics in there instead, stuff that interests me.
Thanks for coming on the show here and talking about this zombie second mortgage, both from the investor's viewpoint as a strategy, and then from the homeowner's viewpoint as to what they can do when they find themselves in this situation. You're an expert in this space, and I really appreciate you coming on the show today and sharing your experience and your expertise.
Thank you for having me. This is my favorite part of my life and career is sharing knowledge. So anything I can do to help, don't hesitate to ask.
I want to thank everybody for listening to this episode. I'm your host, Brian Hamrick from Hamrick Investment Group, and you can find out more about me by going to higinvestor.com. That's HIG investor.com.